Hi, this is Randy Finney with Right Side of the Chart, and today is Thursday, February 4th, 2016. I'm starting this video about 10 to 1 Eastern Time. It's just a quick look at the near-term outlook on the markets for what it's worth. I'll just tell you right here, if you're not a very active trader, probably a good time to be out of the markets. I had mentioned a couple of weeks ago, we came down, hit the lows on Wednesday, where I covered a lot of shorts and reverse long. I was looking for a bounce there, but I believe I stated at the time my belief was that after, we'd bounce and then probably slog around sideways, and that's really all we've done for a while here. So day traders, if you're adept at day trading the charts, money can be made in any market. It depends on your trading style and how nimble you are. And I encourage those, active traders with experience, day traders, share what you're seeing in the trading room. There's others that might want to learn. And again, if you're not, don't try to force trading. If this isn't your type of market and you're not comfortable with these in and out trades, step aside, wait for the next objective swing entry. That's, who knows, could be days away, could be a few weeks away. We'll see. So let's just dig into the charts and take a look at what I'm looking at today. I mentioned in the trading room, I said a couple days, I should have said since yesterday. Yesterday was Wednesday. The market has been in an uptrend. It's a little better defined in the SPY, so that's what I'm looking at here, the S&P 500 tracking ETF. And, again, I talk about a lot. Definition of a trend, an uptrend is just a series of higher highs and higher lows. Is exactly what I'm circling here. So it's pretty clear, straightforward. You have your higher lows down here. Each low has been higher, and you have your higher highs, and that also looks, of course, like a rising price channel. You can draw a trend line under it if you want. I don't have one here. And these trend lines, may or may not get taken out. There's something else worth noting. I'm not a huge fan of head and shoulders patterns and inverse head and shoulders on the daily time frames, although I do recognize them. By definition, if you really read a textbook on those patterns typically form over weeks or months. They're head and shoulders is a topping pattern that comes after an extended uptrend. With that being said, I consider myself a very flexible, adaptive trader, and I've seen a lot of traders and other forums and blogs and newsletters post these type patterns on intraday charts. And the thing is, if you have a lot of eyes and people are using technical analysis and there's a lot of traders out there that are going to take it, then I'll take it. In other words, it'll work. It may have been the case that, over time it's evolved that people started trading these patterns intraday. So anyways, I figured it'd be worth mentioning. And for those of you that don't know what I'm talking about here, that would be the neckline that I just drew down there. I'm just going to put circles here. There's the left shoulder head and a possible right shoulder. So if the day traders and short-term traders are going to trade this, what you'd look for here is a move down, ideally on increased volume. That's one of the criteria to confirm a head and shoulders pattern. You want to see increased volume on the move down off the head and increased volume on the move down from the right shoulder. So right now we don't have increased volume, or at least not much of a noticeable difference on the head. So that doesn't help to confirm that pattern. Maybe we get a move down there. And then if so, you have a neckline here, and you might want to even to be safe. I have really no desire. I'm still long, as I mentioned, taking some longs yesterday before the close, and I'll hold on to those now because I mentioned the trend right now is up, the short-term uptrend. But that would probably be a safer play to wait till about 190.20 goes if you want to try to trade that in that head and shoulders pattern. And there is a divergent high right there. Let's zoom out a little bit, see what this looks like going back. That was a 1-minute chart we're looking at. This is just the same chart on a 2-minute time period, so it goes back a little further in time. This was a bullish falling wedge pointed out the other day. A false breakout, pop, it just kind of shows what happened. It fell shy of the target. So sharp sell-off. So there's what we're looking at here. It just chop sideways. That's, here's a 5-minute chart. What we're looking at here, this 5-minute chart goes back to the 26th. And that was that rising wedge I pointed out. We gapped down below it as expected. That played out nicely. came down for near virtual test of those lows. I should have that line right there to catch that reaction low. And look at that. This is technical analysis, folks, and it tends to work so well during these high volatility periods. You just get the traders stepping in, and the fundamentalists throw their hands up in the air because you can't. Fundamental analysis works great for investing, but it's useless for trading or trying to predict the very near-term trend on a stock. So this is when we traders earn our salt here. All right, this is a sort of a trend line. Like I said, you could be watching. There is a divergent high. Now we've already had a correction off that divergent high, but as I made the case, the trend is up. And looking at the longer term charts, go out to a 60-minute chart. When we hit that level, I had mentioned that we could rally. I thought I'd expected and positioned for a rally for at least a few days, and said possibly a few weeks, and we could go even higher. And there's nothing to say we can't make a 61.8 retracement. Of what I'm referring to here is off the highs back when at least at this point, the S&P had a reaction high back there in early November. So what I did is I calculated the Fibonacci retracement from that high down to the lows. And I put these targets up. Again, I put these up a while back here, and they help me. They coincide with these horizontal resistance levels that I have here. And so we've already met what is typically a minimum retracement in a counter trend rally. Now that's assuming this is just a counter trend rally with more downside to come. So we've retraced, as you can see with the yellow dotted line right back here, is the 38.2 fib. And that's where we stalled at today. We got a little bit above it recently. There's a 50% fib, and then finally the 61.8. And there's other Fibonacci numbers. These are the three that I like to watch when trying to trade counter trend bounces. And there's some nice horizontal resistance there as well. So my most bullish outcome or scenario would be a move up to the 199. We'll call it $200 level because the fib's a little bit above that. I'm not calling for that now. Probably won't be positioned all the way up there, but I do have a mild long exposure. Should the charts firm up. But right now, like I said, trading's tough. Whether you're a bull or a bear, you can't really, nobody can declare victory over the last few days because we've been in a trading range, as you can see here clearly. Let's highlight that. From this point on, that's just a sideways trading range. And so one thing to keep an eye on when you have these trading ranges, breakout to the upside or to the downside will often determine the next direction. So that's something to watch for. And keep in mind, you get these little whipsaws. Remember, these type of markets with a lot of volatility can be tough. So if I take that away, you can see a little, temporary break above here, a few breaks below. And in fact, this trend line should now, or this horizontal line should be lower to catch these reaction lows. So that would be the 187.40 level. Nope, I didn't even get it. We'll call it 187.20, a pretty key level to watch because as you can see here, we've had numerous reaction lows within this trading range. And this line, well, I'll just put a different one up here. There's a reaction high there, although my guess from experience, we have a couple other the candlestick bodies there as well as that candlestick body. So I wouldn't even be looking for a break. I think the bullish breakout, if you will come on a move over 194. So there's the range. That's the range I'm looking at. Let me just hide this number here, make it a little clearer. So call it 187.20 or 194. Break in either direction is likely to spark a rally in the direction which it breaks, barring a fake out, a brief whipsaw signal. And let's see if there's anything else to cover here. Okay, I'll just talk as far as diversified, either the broad market or any sectors on the equity side, not talking about commodities or miners or anything else. This is my only sector I'm trading long right now is the biotechs. And this is a chart I put up recently, 60-minute chart. I thought you can see the volume surge. You can just barely make it out. I have the volume bars muted, but that looks like a selling climax, and we can probably view that if we go out longer term. 2-hour chart. I'll turn the volume up so you can see it on this video, or the color on the volume. That looks to me like a possible selling climax. And I mentioned also closing out the LABU swing short, it's been on for a few months because of biotechs were some key support on the daily chart. So that's how I like to trade. I look at 60-minute bullish. I zoom in on the intraday charts to confirm what I see on the daily chart. So on the daily chart, we had this support zone. This is why I mentioned closing the yesterday, that LABU short trade reactions there, big gap, numerous reactions, top of a support zone. And XBI is the one-time ETF. Let's see here. You can see that support level there on the weekly chart. And so far, a nice little doji coming after we popped off that support level. So like I said, I had planned and do plan to re-enter that at some point, put it back as an official trade idea and get back into the biotech short, because I think before all said and done is there's probably more downside to come, but in the intermediate near term, and I'm talking possibly months, maybe just days, at least a few weeks, I can see XBI moving up. In fact, you can see it hit from this target. All of these targets except this one here were on the 60-minute chart that I posted recently, I believe in the trading room, mentioning a bullish falling wedge pattern on XBI. So you can see we broke out. We to almost to the penny today hit that. That's that same line I had up there at 52.16, and let's see what the high was. High was 51.99, so just a hair below that. And as I often talk about, these are just actual resistance levels. If you're trading this, I always set my targets below. Now I'm still holding. I didn't take out at that first level. Obviously, in hindsight, it would have been nice. Nice to have done so. I thought we'd get maybe a punch up through it, and I still do. We pulled back. We're at support. And, I won't let that trade get away from me. There is some pretty nice support. I do not want to see XBI get much below the, what is this, 48.90 level. Subtract a few pennies for a brief overshoot, maybe wait for a 60-minute close. But if that happens, this would probably have proved to have been a false breakout. So as of now, like I said, I'm looking for a little more upside, and we'll most likely take some or all off the table before we get to 54.48. And again, that all depends on how the charts firm up. If the broad markets start firming up, and I think it might have more legs, and I'll probably take it up to here. But that I can tell you, I see some pretty formidable resistance there at 56.55, and that would probably be it. So again, there it is, a near-term outlook on U.S. equities, cautiously bullish. Although I have mentioned in the trading room just today that we're sitting above some pretty precarious technical levels here. You look at the Qs, look at that support. This is the one I talked about, the 99.80-ish level. There's some overshoots, but there's numerous reactions. That's where trading normalized back in August. Numerous reactions back here, reactions from below. So this is just a uber important support level. So a solid break, and especially a close on the daily chart, is almost very likely. I don't want to say almost certainly, but very likely to take us down another 5% lower or so on the Qs to this 94.50-ish level there. And similar move down in the SPY, more than likely. Okay, this has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.